So with nothing seeming to work in the space recently, how do you play the housing names, if at all, Guy?
I think you stay away, and we've been pretty consistent on this one. They all sort of peaked out, and I'm looking, right around November of last year, and it's been basically a straight line lower. Now, things have bounced since April, like, a lot of the broader market has. But with that said, it hasn't been a pretty robust bounce. And I will tell you, you could trade down, in my opinion, you could trade down the levels that we saw in the fall of 2023, which, by the way, coincides with the low of the TLT. If you remember, that's when 10-year yields went higher. So definitely about yields. I think it's also about the employment picture.
Yes, it's also about consumer confidence. These were April numbers. April consumer confidence was terrible. May, we saw a bounce back. We could see a bounce back a little bit in May in terms of housing activity.
I think we probably will. In fact, I think based upon just what the market has done, there is some correlation to that. But back to the pain in the housing sector and really where things peaked. 2024 overall was the worst week for weekly mortgage applications, since that data was put together back, I don't know, it was even pre-2008. So some of those numbers were starting to get better in the first quarter, and I think as of Liberation Day, they probably get worse. But back to the home builders, there have been some that have been trading just on interest rate sensitivity alone. And I think you can only go to the well so many times on that trade. I think you also got to a place where the housing, the home builders were not terribly priced in terms of valuation, but at some point also those that were eating some part of the financing cost and building that into the overall margin profile. I think we're still in a difficult place. I think the consumer, despite a respite, I think is still somewhat strapped. But, again, soft data is what it is. The hard data hasn't been that bad.
So, the underpinning for sure is rates, right? And if we look at the 30-year, that's just going to be such a super strong headwind. And this cycle, I think that, Tim talked about what they eat in terms of lower rates. They don't seem to be so inclined to continue while they face some other margin pressures. I look at something like copper today going up a lot. That's probably not great. And they've had, it's been a difficult time. So my biggest exposure, single biggest exposure related to housing is Zillow. And I love that asset light model. Remember when they did that terrible foray into owning houses and flipping them? They got out of that. But until we see a lot more activity, this platform isn't going to be able to show how profitable it can really, really be.
They've also, though, been making a lot of leeway into rentals, right?
Yes,
so
that
rentals is a great
excellent point.
addition.
Thank you for bringing that up. That has been an excellent addition for them. But CoStar's also in that space and trying to, they're all trying to eat each other's lunch. Redfin, we saw a deal there. So it's competitive, but we just need more volume. And at this rate, things also own Home Depot, Lowe's. That's not great for them either.
Speaking of eating some of the costs for a mortgage on the part of the home builders, Julie, I read that you can get a mortgage for 5% through a lot of these major home builders. You compare it to a mortgage rate of 6.79% on a 30-year. What are they eating? For how long can they do this? And the fact that we are seeing some resistance forming on the part of the consumer to diving in, even with those buy downs, that's a consumer who's still on the sidelines.
Yeah, I think it's exactly the rate, I think, is the much larger picture and driver in terms of what's happening with this business. The biggest challenge that they have is that really no one wants to pay these higher rates. And not only that, you still have a consumer that is locked into a lot of their long-term mortgages. And with no real rate relief in sight, it's like I listen to a lot of these home builder conference calls and they all talk about this kind of vanishing horizon of when interest rates come down. And, I think what's important to mention is yes, we are technically in restrictive territory, but we're not super high on a relative basis historically in terms of interest rates. It's just most home buyers are really used to rates being much lower. So I think the real question is what does this business model look like if rates kind of stay, maybe 100 basis points lower than they are right now? Are these businesses really as robust? Are they always going to have to offer these discounted rates?